The S&P 500 continues its rally. It's up about 15% this year, compared with only about 6% for the TSX. But if you dig deeper into the stocks that make up the indices, the TSX looks better balanced by comparison. About 23% of the stocks listed on the S&P 500 are doing better than the index, so less than 1/4. While in Canada, more than half of the companies in the TSX composite are outperforming the index. Let's take a closer look at what's going on behind the curtains here, beneath the surface. We are joined by our featured guest, Colin Stewart, CEO and Portfolio Manager, J.C. Clark. It's interesting, we do seem to have a more balanced rally in Canada. I know the headline, the index number, is lower.
Yeah, for sure, Andy. I mean, I think that it just highlights how narrow the rally in the U.S. market is. I think, as we all know, the S&P 500 is being driven by 5 to 10 very large mega cap tech stocks primarily, and that is been widely talked about. I think how narrow the market is. Some pundits have pointed out that's a risk to the market rally in the U.S. And I think, to your point, I mean, the stats that you highlighted show the Canadian market rally is a little bit more balanced. There's more broad participation among different sectors, different companies, and we don't have sort of that very heavy concentration of a few large cap technology stocks like we do in the U.S. So I think it's, and perhaps also a sign we're starting to see a little bit of catch up and better performance in Canada after, as we know, for many years, the Canadian equity market has lagged behind the U.S. really for the last decade or more. So, and our view would certainly be that Canada is cheap on a valuation basis and has the potential to play some catch up here with the U.S. market.
I suppose one factor that might be holding down our index while a lot of stocks are outperforming it would be the weakness of the telecom stocks. They, as a group, are near multi-year lows, near decade lows, actually.
Yeah, for sure. I think there's been negative sentiment on telecom stocks. I think, we don't have as much technology weighting in the TSX component. Even the Canadian banks have underperformed the U.S. banks this year. So, some of the key sectors, as you highlight, really, I think, have underperformed those same sectors in the U.S. And because we have fewer technology companies and less weighting, I think that sort of hurt the Canadian index year to date.
I saw a piece, I think it was in the Financial Post, asking why would you just not buy the Canadian banks? They've been such reliable performers over the years.
Yeah, no, I agree. I mean, we have some small weightings in different funds in the Canadian banks, and I do think, to your point, they're very good business, much less competitive market than the U.S. Really, an oligopoly type business, and very attractive dividend yields at the same time. I think there are some concerns about the Canadian housing market and the Canadian economy not being as strong, but I would say that the relative valuation of the Canadian banks, I think, makes them pretty attractive here.
And the bank index up about 5% in a year. Maybe we could put up the TSX composite to have a look at that. You have another interesting theme here, Colin. We've seen this wave of privatization deals in Canada. We're not. So, yeah, you can see the banks have underperformed the broad index. And we've seen all these companies just being taken off the market. Park Lawn, the cemetery people, massive premium, 60%. Copperleaf Technologies wasn't public very long, a 70% premium. We're not seeing IPOs, but we are seeing go private deals. What does that tell you?
Yeah, I mean, in some ways, it's a bit of a sad commentary on the Canadian market. But I think it also highlights an opportunity. I mean, I think there are a number of reasons for that. There's this sort of undervaluation of many of these small and mid-cap companies in Canada. Things like lack of foreign capital flows into the Canadian market, small cap fund redemptions, poor liquidity in the market, just a number of reasons. I think even people just being down on Canada in general, down on our government, down on the business sort of policies of the government. And that's led to a situation where there are a lot of orphan companies, I would say, in that small and mid cap space in Canada. And I think, the two privatizations you mentioned, both Park Lawn and Copperleaf, there were two stocks that we owned in our funds. And, I think the fact that they were such large premiums and they were being bought by very sophisticated buyers, in the case of Park Lawn, Birch Hill, which is one of the largest private equity firms in Canada, and in the case of Copperleaf, a company called IFS that is a large European software company. But I think, when you see someone do significant due diligence, have better access to information than public market investors do, pay a 60 or 70% premium, and still believe that they're going to earn a double-digit type of IRR on their their investment over a long period of time. I think it just shows really how inefficient the Canadian small and mid-cap marketplace is. And, I think the opportunity is that our belief there is that there will be more of these in Canada. We talked to a lot of management teams in Canada, and I think CEOs and CFOs are frustrated with their poor valuation, their high cost of equity capital. It used to be companies would go public because they'd get a premium valuation. They could raise money, they could use that for acquisitions, but now you've got sort of a strange situation where the private market multiples are often higher in a similar industry than the public market multiple might be, and I think that's what's leading some of these companies to run sale processes, look at alternatives, and for investors, if you can find the right opportunity, be in a good business, many of the companies we own, we're quite happy to own over the long term, but we think there could be a catalyst and that some of them might be taken out, like a Park Lawn or Copperleaf were.
It's kind of a vicious circle, isn't it? I remember hearing somebody say liquidity breeds liquidity. But if you're a fund manager, you're often wary of owning these small Canadian companies because if things go wrong, the stock will collapse and you can't sell it. Nobody wants to buy it off you.
That's true, but I think if the valuation discount becomes wide enough, like we would argue it is today, I think you're paid to take that illiquidity risk, and particularly if you're buying a good business that you know well and you have a longer time horizon like we do on our investments, typically sort of 5 years plus. If we buy a good business, we're happy to own it. We think the earnings are going to grow, and then you sort of have this free option that you get on a potential takeout at a, as we've seen, at a potentially very large premium. And not to say they're all going to be at 60 or 70% premiums, but again, I think it does highlight how mispriced many small and mid-sized companies are in Canada.
I wonder, is the ecosystem broken though? Because we're just not getting IPOs because companies can't get a decent valuation. And it's meant to be there's a flood of new companies with fresh ideas coming on the market, but it looks like private equity has got so big, for example. That's the route.
Yeah, it is. There's a lot of capital that's gone into the private markets, no doubt. But we're still longer term optimistic that if you saw some potentially changes in government in Canada, more business friendly policies, more perhaps a commodity cycle, as we know Canada can be dependent upon commodity prices doing well, and we think we're perhaps at the beginning of that. So that all those types of things could attract more foreign capital, more U.S. capital inflows into the Canadian equity market, as we've seen in prior periods. And I think that would, potentially be, sort of lift all boats and help the valuations and potentially lead to more IPOs, as you suggested, Andy.